All right, let's get the ball rolling here on today's program. While I was gone, the stock market had a very, very bad week. Actually, the NASDAQ had the worst week to start a year since 2000. So we're talking 22 years. The NASDAQ has been the big index that's been rolling along since 2016 with a little burp with the COVID thing, and is really, really, really taken off as we've seen stocks like Apple and Facebook and Tesla and Google, all these big tech stocks really driving the NASDAQ index. Well, last week, the NASDAQ took a really hard correction and is really at a very important technical level. I'll talk about what technicals mean later in the program when I talk about technical analysis. But it's really at a make or break portion of where it should be. And if it doesn't rally this week or if it continues to break down, we got more serious declines ahead of us. The NASDAQ was down 7 of the last 8 days and was the worst performing index by far of any index last week. The S&P 500 was down 2% for the week. Small cap stocks were down 3%, and the NASDAQ had the worst week since February of 2021. So what spooked the markets? What got the markets going down hard? Well, it happened on Tuesday when the Federal Reserve released the minutes from its last meeting. And this is what the Federal Reserve does. You know, they have a meeting, they come out, they announce any change to interest rates, any change to monetary policy. The markets react to it. And then about a month later or so, they release the minutes of the meeting, which is a little bit more detailed than the statement that they make after the meeting itself. And in that statement, they looked hawkish meaning that they're going to tighten monetary policy more than the market expected. And it really spooked traders very, very badly. The committee said that their monetary policy accommodation is going to end. Now, that's not a surprise. I mean, they've said that at their last meeting, that due to inflation, that they're tapering their printing of money and their buying of bonds. But they indicated that they may normalize their balance sheet. And that's what really spooked everybody. Well, what's that mean? Well, there's a few things here we need to know about the Federal Reserve. The first one is they control interest rates. Right now, interest rates are, for all intents and purposes, zero, and have been for a large part of the last 22 years, or even greater, 24 years since the 2008 crash. Well, that's not 14 years, I should say, 12 to 14 years. We've had virtually zero interest rates, and anybody who's a saver or a conservative investor knows how difficult it has been to make money. So that's one thing that the Fed does, is adjust interest rates. The second thing they do, and they started relatively recently, is the quantitative easing, which is the printing of money every month and buying bonds. In essence, financing the U.S. Treasury's budget deficit. And they've been doing that to the tune of $120 billion a month for a long time. I mean, that's a lot of money being printed and pushed into the system. And it's kept interest rates low in the bond market, allowing the government to borrow money to fund deficits at relatively very low interest rates, historic low interest rates. But it's also fueled inflation. And that's where we are now. I mean, you can't continue to print money and not have an inflationary environment, because when you expand the money supply, which is what printing money does, it always results in price inflation later on. First, we saw asset inflation, which was stocks, bonds, we saw commodities, we saw real estate. These are risk asset prices. They went up. That's where the money went that was being printed, into the bond market, into the stock market, into real estate, into cryptocurrencies, to some extent to gold and silver. But now what we're seeing is, as a result of COVID and the stimulus that the Congress provided in the tune of $1,200 checks, in the tune of $300 a month child credits, and all the other money that was printed and injected into the system, some to the tune of $6 trillion, that went to consumers. That didn't go to the banks. So the original QE went to the banks, and the banks took the money and invested it in stocks and everything else. Well, now the money that went to the consumer in stimulus payments, that went into the economy. That was used to buy things. Couple that with the supply chain problems from COVID, and that's why you have the inflationary problem we have here. So the second thing that the Fed is going to do is, or at least they're going to try to do, is taper how much they buy per month and bring it to zero. And they're expected to bring it to zero by late spring. Now, at that point, will they start raising interest rates? Well, the market's expecting 3/4 point interest rates increases later this year, after the tapering is done. Now, the second thing is their balance sheet. Well, the Fed's balance sheet is the value of all the securities that they hold. Prior to 2008, it was something like $600 billion. They weren't regularly in the business of financing the U.S. government debt. They would buy bonds to affect interest rates and things like that, but they weren't funding the debt or monetizing it with created money. Well, that's what they've been doing through QE. And by doing that, it increased their balance sheet to right now, it's $8.7 trillion. So you create this money, then you buy securities, and now it's in your account. I wish I could do that. I guess all of us wish we could do that. I wish we could just print money and buy stocks and bonds. That would be great. The problem is we go to jail for counterfeiting. And the Federal Reserve is the largest counterfeiter in world history. So if they're going to normalize their balance sheet, and this is really what spooks stocks, okay? It was priced in that they're going to taper their buying. Now, the results of that, we still don't know. It's going to be rising interest rates in the bond market, and they may halt that at some point if the economy or markets get spooked continuously. But right now, they're planning on tapering down to zero. But if they're going to normalize their balance sheet, now they're going to start selling securities. By selling securities, who's going to buy them? Who's going to buy all these treasury bonds that they have on the books? Oh, by the way, that are 1.2% or whatever the yield is on them. Who's going to buy them? And who are they going to sell them to? Well, they were the buyer of last resort. And who's going to buy the new debt being issued by the federal government? That's going to skyrocket interest rates and destroy the housing market, destroy the stock market. So stocks turned south quite hard after that news came out. Now, I don't believe it's going to happen. I don't. Because I don't think that the markets will allow it to happen. If you remember back in 2019, the Fed started to lighten up its balance sheet. It was starting to sell securities and did so for a number of months. And then we hit September 2019, and JP Morgan then crashed the repo market and forced the Fed to launch not QE, but it was QE. All right. So basically what they did is, if you remember, I was reporting it on this program in 2019, that these big banks were requiring tons of money to the tune of almost $1 trillion a day to stay liquid. And that was a result of just a small increase in normalization of the Fed balance sheet and raising interest rates just a few quarters of a point. The market couldn't handle it. Now, the market's even worse off now, so how will the market react to the tapering of QE? That's been the cocaine that's moved the market over all these years. Because the market, you can't justify the valuations of the stock market. You can't. Any metric you use, price to earnings ratios, price to sales, value of the market compared to the GDP of the country, are all higher than they've ever been, going back to the crash in 1929. So, I mean, stocks are extremely expensive. And the only reason they got there was because of quantitative easing, zero interest rates. If the Fed reverses that, well, what do you think the natural result is going to be? The opposite of what we saw. We're going to see selling of stocks. We're going to see the market go down. We're going to see real estate go down. I mean, the real estate market, it's done fantastic. It's done fantastic because we had sub 3% mortgages. If mortgage rates go to 4%, it'll kill the housing market. Absolutely kill it. So the Fed has to be worried about that. And the question is, how scared will the Fed get if they see a 20% drop in stocks? Oh, by the way, every time in the past that a central bank has had a zero interest rate policy and began raising rates, 100% they went back to zero. The markets could not handle it. 100% of the time that's ever happened, including the last time our Federal Reserve in 2019 reversed zero interest rate policy. They went back to zero again. And that's the thing, is the markets and the economy is so fragile to interest rates because of the massive amount of debt that's been incurred by the U.S. government, states and cities, households who have record amounts of debt, and corporations who have been borrowing money through issuing bonds at these low interest rates so they can buy back their stock and enrich the shareholders and the directors and officers. And 2021 was a record year for buybacks. And 2022 is going to be another one. But all this has been fueled by very, very low interest rates. And my guess is that this market's going to be so fragile, because look what happened just this week with them talking about potentially doing it faster, not actually doing it. Now, there's one more question we have to ask here. Biden and his administration are freaking out about inflation, and they want it brought under control. But what about a market crash? How would that do if, say, the stock market drops 20 or 30% or more? How will that help the Democrats at the polls in the midterms? They're already a disaster. It's already going to be a landslide, not to mention 2024. So now the administration is between a rock and a hard place. If inflation runs rampant, that's not good for them. Forget about the country itself, but we're talking about the party. And if the markets crash, that's not good for the party. So the solution to inflation, it will be the cause of a crash. Talk about a catch-22. And if we start seeing interest rates starting to go up, I certainly wouldn't want to be in the stock market. And I know that the Fed will, as they always have, there's something called the Federal Reserve put, meaning that as the markets are going down, the Federal Reserve will always be there either to buy the market or to rescue it with lower interest rates or quantitative easing. And it's not to help you or me, but it's to protect $145 trillion in U.S. net worth that is in the hands of 1%. By the way, that's going to be the only legacy that the Fed leaves when it's all over, is that the top 1% got rich during the day. Other news that came out on Friday is that it was a big surprise. The U.S. economy only added 199,000 jobs when economists were expecting 400,000 jobs to be created. And that's a big miss. This is what CNBC had to say about that. And this was the worst month in the Biden presidency as far as job creation goes. It was very, very low. So this is what CNBC said about it.
Steve, what's the number? 199,000, another big miss here. November revised up to just 249 from 210,000. Private sector jobs were 211, so it looks like we might have lost some government jobs there.
All right, so CNBC, you can look at them, their faces, because it is NBC, by the way. They were pretty dour and pretty freaked out about this, because this doesn't help their boy, you know what I mean? So they were pretty unhappy about it. But Biden was really happy about it. It's amazing how this government will come out and spin anything as positive. If you recall, when gasoline prices peaked a couple of months ago and went down 2 cents, the website for the White House put out a chart, but the access was so tight that it looked like prices crashed because it was only like an 8-cent range. So you see it going up and then you see it come down and it looks like, oh, look what we did. We saved you 2 cents a gallon. So they'll spin anything. I'm not saying this was a miss or anything else like that. This is what our esteemed president had to say about it.
This morning, I want to talk about, I think it's a historic day for our economic recovery.
Everybody in the financial press and financial TV is out there saying what a disaster this number was, and he comes out and says it's a historic day for our economy. I mean, you can't make this stuff up. But what he was touting was the unemployment rate went down a little bit. So that's what he's talking about. Not the fact that only 199,000 jobs were created. Well, the unemployment went down because 4.5 million Americans quit, the highest level in history, quit their jobs, and a lot of Americans just aren't coming back to work. Or because of the new COVID mandates and restrictions, people are moving on, or they're being fired. I don't think that's a big surprise. I wasn't surprised at all when it came out. But see, they'll spin it anyway. It was a historic day. We've created more jobs than any president in the history of the nation. Well, people coming back from being locked down in COVID, but we're still 2 million jobs short of where we were prior to COVID. Just amazing what's going on. Let's take a break. 732-505-1160 is our call number. My name's Lou Scatigna. You're listening to The Financial Physician. Don't go.